What if the United States suddenly decided to pay off its entire national debt? Not just a small portion, not just trimming it down, but wiping out all $37 trillion that the country currently owes. On the surface, that might sound like the perfect solution to America's financial struggles. After all, debt has always carried a negative image. Whether it's personal debt, credit card debt, or government debt, the idea of owing money feels like a burden. So naturally, many people believe that if the US could somehow pay it all back, the country would be stronger, safer, and freer from economic risk. But the truth is far more complicated. When you're talking about the US economy, the largest and most powerful in the world, the national debt isn't just a simple IOU that disappears when you write a check. The debt is deeply tied to how global finance works, how governments operate, how citizens invest, and even how the dollar maintains its position as the world's most dominant currency. Today, we're going to explore what would really happen if the United States paid off all of its $37 trillion debt. And trust me, the answer is not as simple as, everything gets better. In fact, some of the outcomes might surprise you. For some, it could be positive: more stability, less interest spending, and stronger creditworthiness. But for others, it could spark chaos: collapsing financial markets, less global trust in U.S. Treasury bonds, and a fundamental shift in how the world uses the US dollar. We'll break this down into 4 key parts. 1. The true scale of $37 trillion, what it really means in global terms. 2. What would actually happen if the US managed to pay it off? 3. The consequences for America's economy and the rest of the world. 4. And finally, why this scenario is almost impossible to achieve. By the end, you'll see that US debt isn't just a burden, it's also a pillar of the global financial system. Removing it entirely would change the world in ways most people can't imagine. Let's dive in. When we talk about trillions, the numbers become so large they're almost impossible to comprehend. But to really understand what paying off $37 trillion means, we need to put it in perspective. The US economy, the gross domestic product, or GDP, is about $28 trillion per year. That means America's total annual production of goods and services is still smaller than the total debt. If the government wanted to pay it all back at once, it would need more than an entire year of the nation's income, and that's assuming every single dollar of output went toward the debt, which obviously isn't possible. Now let's compare it to the average American household. If you take the $37 trillion and divide it by the roughly 125 million households in the US, the share comes out to nearly $300,000 per household. That's like every family in the country writing a check for a house-sized debt tomorrow. In global terms, $37 trillion is more than the GDP of China, Japan, Germany, and the United Kingdom, combined. That makes it one of the largest financial obligations in human history. But here's the twist: this debt isn't owed in the same way that you or I owe a credit card company. A huge portion of it, over 70%, is owed to US citizens, institutions, pension funds, and the Federal Reserve. In other words, America owes money mostly to itself. Another chunk is owed to foreign governments like Japan and China, who buy US Treasury bonds as safe investments. Treasury bonds are the backbone of the global financial system. They are considered the safest asset in the world. Pension funds rely on them. Banks use them as collateral. Foreign governments use them to stabilize their currencies. If the US suddenly paid back all $37 trillion, that wouldn't just mean America is debt-free, it would mean the world's safest investment vehicle disappears overnight. So before we even talk about the benefits or risks of paying off the debt, we need to understand this: $37 trillion isn't just a number. It's a system. It's how the world stores money, how institutions plan for retirement, and how countries manage trade balances. Taking that away would be like removing the foundation of a skyscraper. It might not collapse instantly, but everything above it would start shaking. Now let's imagine the US actually did it. The debt is gone. Treasury bonds are fully redeemed. The balance sheet of the government shows debt equals $0. What changes? The first effect would be on the government's budget. Right now, the US spends hundreds of billions of dollars every year just paying interest on the debt, money that doesn't go towards schools, healthcare, or infrastructure. If the debt disappeared, all that money would be freed up. Theoretically, taxes could be lowered, spending on public programs could increase, or the deficit could shrink dramatically. That sounds great on the surface. But remember, those interest payments also serve as income for investors, retirees, and institutions holding government bonds. If all U.S. debt is paid off, those income streams vanish. Pension funds would lose safe assets. Insurance companies would lose predictable returns. Investors would have to look for alternatives, which could cause them to pile into riskier assets, driving volatility across financial markets. Another big effect would be the U.S. government's borrowing power. Ironically, one reason investors trust U.S. bonds so much is because America always has debt. By consistently issuing Treasury securities, the U.S. provides a constant supply of safe assets. If those disappeared, global financial markets would scramble to find a replacement. Some analysts think Germany or Switzerland might step in with their bonds, but their economies are too small to fill the gap. The U.S. dollar could also be affected. Right now, the dollar is the world's reserve currency in large part because of the depth and safety of U.S. debt markets. If that vanished, countries might look for alternatives, like the euro, yuan, or even digital currencies. That shift would weaken America's financial dominance. So while paying off the debt might sound like a win for taxpayers, it could destabilize the very system that makes the dollar so powerful. America wouldn't necessarily become stronger. Instead, it might find itself in a weaker global position, with fewer tools to influence trade, diplomacy, and finance. Let's go even deeper into the consequences. If the U.S. paid off $37 trillion tomorrow, what happens to the economy in practice? First, there's the problem of how the debt gets paid. To generate that kind of money, the government would either need to drastically increase taxes, slash spending, or print new money. Each of those comes with serious risks. Massive tax hikes would slow growth and crush consumer spending. Spending cuts would shrink the economy and throw millions out of work. Printing money on that scale would cause hyperinflation and destroy trust in the dollar. Assuming somehow the debt is still paid, the U.S. financial system would go through a shock. Banks that use Treasury bonds as collateral would struggle. Investors looking for safe havens would panic. Interest rates could become unstable, because without Treasury yields as a benchmark, global lending markets would lose their compass. Trade would also be disrupted. Right now, countries like China hold U.S. bonds as a way to manage their trade surpluses. If those bonds disappeared, they'd have to find new ways to store wealth, maybe buying more gold, real estate, or foreign assets. That would increase competition for other asset classes, potentially creating bubbles. Domestically, there would be winners and losers. Taxpayers might celebrate lower taxes or better public services. But retirees relying on bond income would suffer. Financial institutions would be forced to re-engineer their entire investment strategies. And without a steady supply of U.S. bonds, the Federal Reserve would lose one of its most powerful tools for managing the economy: open market operations. In short, paying off the debt doesn't just affect Washington, it affects every corner of the economy, from Wall Street to Main Street, and from New York to Beijing. Now for the final piece: is paying off the U.S. debt even possible? The honest answer is no, not in the way most people think. Unlike a household, the U.S. government doesn't have to pay off its debt entirely. Because the dollar is the world's reserve currency, America can roll over debt indefinitely. Old bonds mature, new bonds are issued, and the cycle continues. As long as the U.S. maintains credibility and economic strength, investors are happy to keep buying. In fact, many economists argue that the debt should never reach zero. Debt provides a safe asset for investors and a powerful tool for the government. Without it, the system breaks. There's also the issue of size. $37 trillion is growing every year, and paying it off would require either unprecedented taxation or spending cuts that no government could realistically enforce. Politically, it's impossible. Economically, it's unnecessary. Think of U.S. debt like oxygen: it's always there in the background, and while too much can cause problems, you can't live without it. The goal isn't to pay it all off, the goal is to manage it responsibly so it doesn't spiral out of control. This is why most experts don't even consider a scenario where the debt is fully paid. Instead, they focus on sustainability: keeping debt as a percentage of GDP at manageable levels, ensuring interest payments don't overwhelm the budget, and maintaining the trust of global investors. So what really happens if the US pays off its $37 trillion debt? On the surface, it looks like a victory: no more deficits, no more interest, and a clean balance sheet. But beneath the surface, the story is much more complicated. Paying off the debt would destabilize global finance by eliminating the world's safest investment. It would rob retirees, institutions, and governments of income. It would undermine the dollar's status as the reserve currency. And it would leave the US with fewer economic tools. The truth is, debt is not just a burden, it's also a feature of the system. The real danger isn't that America has debt, it's how that debt is managed. As long as the US maintains growth, credibility, and stability, the debt can continue to exist without collapsing the economy. So while the idea of paying off $37 trillion sounds attractive, it's not realistic, and it might not even be desirable. The real focus should be on sustainable debt, smart fiscal policy, and long-term economic growth. At the end of the day, the US debt isn't going anywhere. And maybe, just maybe, that's not such a bad thing.